A big thank you to our sponsors over at TaxCalc for making this video possible. If you're not familiar with the brand, then you really should be. TaxCalc makes award-winning professional accounting, tax, practice management and communications products, and they are trusted by over 9,500 firms across the country, including mine. Check them out at taxcalc.com, and I'll also pop a link in the description for you to give it a try. Now back to the video. I know what you're all thinking. Who even reads them? Probably not many people, but for those that do, or would if they understood them, I thought I'd put together a little summary of what everything means. If you've watched my previous video on what type of accounts can a small company prepare, you will understand that there are many different types of accounts that can be used. For the purposes of this video, I am going to be looking at a full set of FRS 102.1a accounts in more detail. First, we have the front cover, which says the entity name and often the company's house number. Then there is usually a contents page for easy referencing of the various pages, obviously. The next page is the director's report, and this is one of 2 pages you will need to sign as directors. The point of this page is to say that you, as the director, accept full responsibility for the accounts, how they've been prepared, and that they are true and fair. This page also shows what the company does and the directors' names. Following this, we have the accountant's report, dum dum dum, where we exclude ourselves from any and all liability. I'm kidding. It lays out what we have agreed with you, the director, that we are bound by the ethical guidelines of our institute and that we haven't been asked to do an audit. We, as the accountants, sign this page. Basically, we are again putting the onus for the figures back onto you. Soz. Next up is the profit and loss, the interesting bit. This will show what year the results are for at the top. It will then lay out in summarised headings what sales your company has made and the various expenses, and ultimately the profit before tax and the profit after tax. It will show your gross profit, which is your turnover less any direct costs. It will then show any overheads and the operating profit. The balance sheet is on the next page. This is a snapshot in time of what the company owns in terms of assets and what it owes in terms of liabilities. The balance sheet is always prepared to the final date of the company year. So if you have a 31st of March year end, then your balance sheet will show data as at the 31st of March in the accounts. It will also show your share capital, the value of any shares that the company has, and any retained earnings or profit and loss account. I doubt it will shock you to know that the balance sheet must balance. The total amount of net assets must equal the total share capital and how much the company has in retained earnings. People sometimes get confused by the retained earnings. This is a cumulative figure for what the company has made profit-wise that hasn't been taken out by the shareholders as dividends. So if in year 1 a company makes £100,000 profit after tax and the shareholders take £50,000 of it in dividends, the retained profit would be £50,000. If the same happened the following year, the retained profit would be £100,000 and so on. So the bit after the balance sheet is a second place the directors must sign the accounts. You are basically confirming what basis the accounts have been prepared under. Only one of the directors needs to sign the accounts, but we tried to include all of the directors as signatories unless instructed otherwise. In the following pages, firstly you'll find accounting policies and then many notes to the accounts. Most of the notes are quite wordy until you get to the detailed breakdown of some of the figures in the balance sheet, such as fixed assets and creditors and debtors. As accountants, it is not only our job to make sure that the figures are right, we must make sure that the disclosures are right. Sometimes this takes even longer than making sure the figures are right. You must disclose any related party transactions and balances in the notes. So this is why you will often see a director's loan account note further down. It will show how much the directors have borrowed, how much has been repaid, if any. It will also show how much, if anything, is outstanding still at the year end. And the last part of the full accounts is a detailed profit and loss account. This basically just breaks down all of the income and expenses into their various categories. It's really useful to be able to compare year on year if there have been any fluctuations. Accounts can look daunting at first, but the main thing to remember is they need to be a true and fair reflection of exactly how your business is doing. You must have adequate records to back up every single figure in your accounts, or face a lifetime in prison. Okay, maybe not a lifetime, but they need to be right. Thank you for watching. Hopefully this has been really useful, and thanks again for our sponsors TaxCalc for making this video possible.